Hello, good afternoon, everyone. We are very privileged and excited to bring you yet another version of Netra. Coincidentally, this is the 23rd version, so we'll be finishing 2 years of writing this just next month. And I think markets always gives out signals, news for us to analyze. With this version, we are seeing a lot of noise around the US debt ceiling. We've been writing in many of our reports that we do think that we are in a bull market, but there are intermittent pullbacks that we may see. And with that context, we analyze the current news. What is the signals that markets are giving out with Sahil Kapoor, who is the chief market strategist as well as heads products at DSP, and who writes this very, very consistently. I think working with Sahil, we all look forward to doing this exercise at the end of every month. And we are very excited and privileged to present to you the 23rd version of Netra. So with that, over to Sahil for his thoughts, insights, and what he's seeing in markets and investing.
Thank you, Ankita. Thank you for the intro. And so guys, this is, as Ankita said, we release this report 5th of every month. And this version that we are talking about today is, focused on three aspects. First, which Ankita highlighted, this whole debate around US debt ceiling. We'll look at it in some detail and look at what are the market signals from the various aspects that are available, right? We will look at a few market signals which are important as of now. The second part of the presentation, we look at some of the important indicators coming from inflation and their impact on gold. And in the third part, we look at some domestic Indian macroeconomic data and some thoughts around our monetary policy and the sectors that we are seeing are very important. So this will be the flow of the presentation. And so I'll start with the first part, which is, now my screen should be visible to all of you. And specifically, what we are seeing is that there is a massive debate happening around US debt ceiling. And one key important aspect, which I was speaking to one of my friends just a few days ago, and he said that nobody seems to care about US debt ceiling, right? And which is a very important, pertinent comment. And we have seen this happen in the past. And I will explain to you how this, event played out very recently. We don't have to go too far. So first, let's look at what this whole event is all about, right? So the US debt ceiling is what it's roughly the debt limit. So if you see these red and blue line on the screen, there is a chart which has three lines, red, blue, and black. The red line is the US Treasury public debt, which is the actual debt that the US has at any point in time. And the blue bars that you see, the blue line, it is going up in steps. This is the statutory limit of debt that US can have. So until 2011, this debate did not happen whether US will raise debt ceiling or not. It was a very natural outcome that whenever the debt ceiling was hit, they used to increase it. There were not many debates at that point in time. But during Obama's term, there was a ferocious debate in 2011. And some senators from the Republican Party said that they will not allow the debt ceiling to be raised unless and until some concessions on spending happen and a roadmap for reducing US debt is presented. So that was the first argument in the recent memory where debt ceiling became an issue. And historically, what we've seen is that it has been raised or suspended over 100 times, and it was introduced in 1917. So this is an event which is a known event. It's not an unknown event. It's not something which is coming out of the blue. So the market already knows when this will happen. There are estimates and calculations which are available. So roughly the definition is very simple. It's the amount of debt which US can have at any point in time. If it exceeds that number, the US Treasury cannot borrow more money and continue its operations. So US runs a fiscal deficit, right? All of us know that. Right now, the deficit number is close to about $1 trillion or more, right? So every year they borrow that money and they run their operations. They spend a lot of money because their revenues are lower than their expenditure. And in order to do that, they borrow money, right? So this borrowed money or any sort of revenue that US government has after spending money is accumulated in this black line, which is the US Treasury cash balance, right? So you can see that the cash balance has fallen close to zero now. It's about 200 billion or so. Then they can run through this balance very, very quickly. The US Treasury Secretary Janet Yellen is saying that it will be over by 1st of June, right? And we are today sitting on 8th of May, and nobody seems to care a lot about it, right? And that's been the case that we've seen. And so there are two very important things. One, this is not a new event; it's a known event. Market has known this for 100 years now. Second, there has never been an instance in the past where US debt ceiling was not eventually raised. They usually raise it. There have been some instances where it was not raised and the US government was shut down. And I will show you one of them. And that shutdown resulted in economic loss. It also resulted in 2011, the impasse resulted in downgrading of US outlook. The US rating was cut from AAA to AA in 2011, largely because of the debt ceiling. And in both these instances, there was a large market reaction, right? And we have seen that market reaction happen. So I will now show you what happened in 2018-19, a similar event that we can go back and refer to and at least learn from it. So in 2018-19, you can see that this big red bar that you see here, which is December 4th, there were negotiations happening. There was expectation by 22nd December 2018, the US would have utilized all its cash balance and it would have hit its debt limit. The expectation was that they will raise the debt limit before that date. And there was, as usual, an impasse in US Congress. And Donald Trump did not agree to the concessions that Democrats were asking at that point in time. So on 11th of December, Donald Trump came on television and he said that he wants $5.7 billion in additional funding to build the Mexican wall. He was building a wall near Mexico, if you remember, not in so distant past. And that was not agreed upon. And on 22nd December, the US government went into a lockdown or a shutdown, and it remained in a shutdown for 35 days. And so this news was known in the market. Market did not react until, let's say, 3rd of December. Even you can say that by the 10th of December, nothing major had happened. But after that press conference, 2-3 days after that, market started selling off. It sold off nearly 10-15%. So you can see that from the peak of about 25-26,000 in December, the market went down to 21,600. Now, you can't say that solely this event was because of the debt ceiling. There were many other things also happening at the same time. US economy was slowing down significantly. At that point in time, US Fed was raising interest rates. So there were many similarities and dissimilarity. But what was interesting is that the market bottomed out on 24th of December. So the market anticipates these changes before they occur, and there are tea leaves that the market will, of course, read and come to conclusion. So the moot point is that today we are sitting on 8th of May. According to the US Treasury, they will exhaust their resources by 1st of June. According to some private calculations, US Treasury can do a number of things. For example, one idea which has come about is that US Treasury can issue $1 trillion mint coin. Okay, and that Treasury will deposit that coin with the Federal Reserve, and it will give them $1 trillion in limit overnight. So these and many other, novel ideas are floating around of how it can be avoided. So there is a possibility that the US Treasury can adopt some of these measures. But the idea is that this is an event which is what I call a known unknown. So you know the event, but you do not know the outcome. Even for the outcome, there is a 99% or maybe, I can't put a number, but a very high probability that it will be resolved. That means the debt ceiling will be raised. Now, what is the concern? Let's look at second chart. So the second chart has two lines again. It is the BOFIML move index, which is the volatility index for bonds. And the other line that you see, the black line, is the US credit default swap. So credit default swap is nothing but like an insurance against US debt. If CDS prices are going up, that means the market expectation that US debt paper will default is rising, right? So if you see clearly, US 5-year CDS is now higher than it was any time in the last 15 years. It was higher only during the Lehman crisis and during the 2008 bust. Since then, it has reached a very, very high number. So I think it's pertinent to note here that the market is expecting some kind of an event, which we do not know today. And therefore, the CDS rates have gone up significantly. And my understanding is that we should not ignore it. So let's review what I've said until now. First, that we know the event. It has happened over 100 times in the past 115 years, 116 years, happened 106 years, happened many, many times. We also know that the probability of US government defaulting, in case there is a shutdown, there is a possibility of a default also, but that possibility is very, very low, right? Maybe in some basis points. But the problem is that if it happens, the outcome is going to be very, very large. Historically, we've seen that when there is a shutdown, there are econometric calculations possible. That's, for example, if there is a 30-day shutdown and then the government comes back online, economic activity gets compromised by 1%. So if the GDP growth would have been expected at 2.5%, on a monthly basis, you will see that a contraction of 7-8 basis points will happen for the GDP because of this event, which otherwise would not have happened, which is a very large number, right? So in 2018-19, US bond yields went up by about 80 basis points because of the event, right? That is what the CBO calculations show, which is the Congressional Budget Office. They show their own calculations. So the key takeaway is twofold. One, the volatility is going higher in the bond market. CDS prices are going up. So there is something which the market is expecting or anticipating. And at the same time, equity volatility is very, very low, which I will show you in the next slide, which tells you that the probability of any untoward event happening is, although is very low, if it happens, the outcome is, so to speak, catastrophic or possibly which has very bad implications, right? So in case of a shutdown or a default, other markets will simply, see a lot of spillover effects or collateral damage. And why is that? Because US Treasury is the most liquid and most important asset class in the world, right? So the moot point is an event with low probability of happening, but if it happens, the impact will be very, very high. Now let's look at what the equity market is doing. So if you go to the volatility index, so what I've done is I've put two indices here. I've taken Nifty index and I've taken India VIX. And if you look closely, what the title of the slide says is volatility crush. So volatility is at a multi-year low. If you just ignore the 1 week that we had prior to COVID, that was one of the lowest volatility on record for VIX. But outside of that, I think we are at one of the lowest VIX readings that we've seen in years or possibly ever, right? Since the volatility index is available in India, which means that protection or options are trading at extremely cheap levels in India. Or you could also say that the market is very complacent. Okay. Now there is a twist to the argument. What is the twist? Historically, what we've seen is that when volatility is so low, it is usually a sign of a healthy bull market. It usually happens in secular bull market that volatility becomes so low. Okay. But now from the last two slides, there is a context of an event playing out. Okay. What is that event? An event where the probability of happening is very low, but if it happens, the impact could be very, very large. And now when you look at equity markets, you see that volatility is extremely low, possibly also hinting that we are in a continuous bull market, right? And therefore, what is our prognosis? What we are saying is that you should continue to have your equity allocation steady, because we know that these indicators still tell us that we are in a bull market. And if you are a reader of our past reports, we have continuously shown how at various levels equity allocation should have been raised, right? But at this point in time, what we are seeing is that because protection or volatility is so low, it makes sense to possibly hedge yourself. That means buy out of the money put options, which will allow you to play or see through an event. So if the event does not happen, you lose the option premium, which is extremely cheap today. It doesn't cost a lot to hedge yourself. But if an event occurs, the hedge will protect you against an untoward event or against a spike in volatility and a market crash. And that will allow you to continue to hold on to your equity positions. So I think the prognosis is very clear, that this is an event where, because volatility is very low, it makes sense to hedge yourself. And the other part is also very true. For example, if you are an investor with a 5-year horizon, this probably will become an event which may not be very, very important to you if it doesn't happen, right? Even if an event happens and there is a shutdown for 20, 30 days, it may not affect your long-term returns to a very large extent. That is also possible. But there is a third possibility also, that there is a shutdown and there is a default. That is an event which will definitely impact every single portfolio. And I think that is the reason why these tail risks can be hedged, right? And because this is a known event, because we have the history and we have an instrument which is placed at a cheaper price today, it makes sense to have a part of your portfolio hedged. So the idea in prognosis is very clear from the first segment of my presentation. An event risk which is unfolding. Historically, we've seen that it can cause a lot of volatility in the market. It can also cause some mini crashes. So it makes sense to hedge yourself ahead of this event, and then let's see how it plays out. We don't have any predictions of how it will happen, but if history is any guide, we will probably see a lot of negotiations happening in US. For the simple reason is that for US to raise debt ceiling, it needs majority in both houses, Senate and House of Representatives. In both the houses, Democrats do not have majority, right? So they need support from Republicans, and these debt ceiling can be raised only through a majority vote, right? So I think a lot of negotiations will happen. It's a political slugfest, not an economic event, but implications are very important if it does not happen. Let's go to the second section of our presentation, which is on growth and inflation. So what we've seen is that over the last 1.5 years, a lot of inflation numbers which have started to cool off in the last 6 months happened because significant reduction in supply side inflation. So if you see the chart on the top left, it has got two lines. One is the red line and one is the black line. Let me magnify it, right? So if you see this chart on the screen, the red line is demand driven inflation and the black line is supply driven inflation. And what we've seen is last 6 months, supply side inflation has fallen. And why it has fallen? Because commodity prices have come down, logistic costs have come down, input prices have reduced. But demand side inflation has still been sticky. And you can see that it has started to consolidate and probably turn. And that is the argument of this slide. That are we seeing any signs that demand will also cool off and therefore inflation will decline at a faster pace? So I think that is quite probable. And if you see the second chart here, so what we've done is we have taken US banking credit growth, and you can see that it's at 2.4%. Latest data is below 2%. And this is one of the slowest growth number that we've seen outside of global financial crisis in US, right? It also has some base effect. But as you know, with banking consolidation happening, small banks struggling in US, there is a clear reason for credit growth to slow down in US. And it will definitely impact the economic activity in US, largely from the demand side, because large part of demand in US is driven by credit, right? So it's a direct proxy that demand side conditions in US are deteriorating. Second, another important part from the same market is the job market. What we've seen is that the job openings number, which is the black line here, has started to cool off. I've advanced it by 6 months, and the Atlanta wage tracker, which is the Fed, publishes this number on what type of wage increase is happening in US. You can see that the wage increase is at 6.5%. Usually, it is led by very strong job growth or job openings in US. When there are abundant job openings, there is a very large wage increase that happens. Let me put it in more simpler language. US job opening rate is the number of jobs which are available in the economy. If the number is going up, that means there are more jobs and less people, and therefore wages go up, right? When this number starts to come down, that means number of job openings are falling, new job openings are falling, and therefore the expectation is that even the wage growth will cool off, right? So the credit growth is slowing, wage growth probably is going to slow down going ahead. And third and more important point is that within the US inflation basket, uh, housing prices and rents are very, very large component. So rents, which is CPI shelter, is 1/3 of US inflation. And you can see that rental market is driven by home prices with an advance of 18 months. That means home prices peak, and then after 18 months, US rentals also peak. And what we are seeing is that US home prices peaked about 18 months ago, and we are somewhere currently in the month of Feb, March, or April, in the months where rental inflation is also going to peak out in US, right? So if you put these aspects together, one very large component of inflation, which is rent in US, has already peaked and is going to come down over the next 6 months. Second, wage pressures are going to cool off, which has caused a lot of inflation in US, and credit growth is also slowing down, which again is a very important indicator of demand, right? So if these indicators are going to slow down, there is a good possibility that the inflation numbers that we are seeing will cool off significantly. Last month, US CPI came at 5%. This month, it will again come at 5% roughly. That is the consensus and statistical model. And even the nowcasting model is saying the same thing. But in the next month, that means when data comes out in June, mid of June, US inflation is likely to fall to about 4.3% or lower. And statistical models tell us that by the time we reach September, US inflation will be below 3.5%. And if that is the case, what will happen? It will dissuade Fed from raising rates any further. So if you look at this chart, it has two lines. One is the black line, which is the Fed funds effective rate. The rate in this chart is at 4.83%. We made this before the Fed announced its monetary policy on 3rd of May. Right now it's at about 5%, right? 5 to 5.25. So the effective rate is 5.13, right? That is the effective rate right now, Fed funds effective rate. If inflation is going to come down, it clearly means that Fed is not going to raise interest rates. And Fed has, pinpointed similarly on 3rd of May that they might not raise rates anymore, right? The second line in this chart is gold divided by S&P 500. So essentially a ratio. So when this orange line or the amber line is going up, in that period, gold has outperformed S&P 500. That means gold has outperformed stocks. And if you're able to watch this shaded area, what is interesting about this shaded area is that whenever the Fed has embarked on a rate cut cycle, gold has outperformed equities. So every time this has happened, you can see that gold outperforms equities by a very, very large margin, right? And even in the last 2018 cycle, gold outperformed equities by a large margin. Now the hypothesis is that if the hypothesis that inflation is going to cool off and Fed is not going to raise rates anymore, at some point in time during the year or next year, Fed will embark on rate cuts, right? And that will happen because economy is slowing down, inflation is coming down. So we don't know when will it happen. We don't have a crystal ball, but sometime in 23 or in 24, the Fed will embark on rate cuts. And historically, whenever that happens, gold has outperformed equity by a huge margin. And even the biggest gold bull markets have happened during that period, right? Which means that you can now go back to the gold prices put together and see that gold is now trading very close to a lifetime high. And it's been trying to breach and go to a new lifetime high, 2085 being the lifetime high on NYMEX futures. If it is able to breach that level, it will enter possibly a new bull market just basis the price numbers, right? So there is a good expectation that gold actually could be a very good asset class over the next 1 year, 2 years. if this breakout occurs and if the hypothesis which I presented to you plays out. So one very key takeaway in conclusion, over the next 1 or 2 months, when inflation numbers are announced and data comes out, a lot of people are going to pay attention to the equity market. But I think the most sensitive asset class will be gold. And from that, as a proxy of that, gold mining equities, I think, will be one of the most sensitive asset classes, because this could probably make or break the bull market, which is possible in gold and gold mining equities. So the conclusion is very simple. Demand side indicators are now slowing, which will probably cause inflation to fall at a faster pace because supply side inflation has already come off. And that will allow Fed to initially not increase rates and then later cut rates. And whenever there has been rate cuts, usually gold has outperformed stocks in that period. And I did not tell you the reason why. Usually people prefer high yielding assets when interest rates are high, and when rates are very high, low yielding assets like gold do not perform, right? And when the opposite happens, people prefer gold. That means if bond yields are very low, uh, usually people prefer to buy gold, and if it enters a momentum which is like a new lifetime high, you will see investment demand also picks up and gold prices perform even better. So this was the second section on why a dynamic between inflation and gold can play out. The third section is on India, which again throws out some very important data points. So we have looked at high frequency data once again, and what we are seeing is that the data continues to remain steady. We are seeing that there is steady progress. 3 months ago, or when 2023 began, we heard a lot of expectation that Indian economy will slow down, numbers will fall off the cliff, but we haven't seen any significant slowdown. I must tell you that there is some consolidation in data which is happening. So GST numbers, although at lifetime high, are still slightly below the trend growth that they should have been. They should have been even higher, maybe at 1.9 or so. From a statistical perspective, but I think they continue to remain very healthy. And secondly, you can see the total e-way bills are also at lifetime high, near lifetime high, also still slightly lower. So there is some consolidation which is visible in some data points, but most data points continue to remain quite robust. So our economy is doing fine. It continues to grow at a steady pace. With some signs that it is consolidating, but still we can't find any significant slowdown signs. And when it comes to business activity, it continues to remain quite robust. Most PMI numbers that we are watching are showing you that business climate continues to remain excellent, right? So which again tells you that on the whole, the economy is doing fine. It is growing at a steady pace. Second is that Indian macro also offers a lot of stability. And what we have seen is that there are very few countries globally today who have been able to bring back their inflation numbers within the mandate of their central bank. So if you look at country by country, currently there are only India and Thailand where inflation is within the band of central bank's inflation targeting mechanism. So India has a band of 4 plus minus 2% inflation. And currently our inflation is 5.7. The expectation is that the number for May, when it is released, that is the inflation number for April, will be below 5%, maybe closer to 4.7, 4.8%. So inflation remains within RBI's comfort zone, unlike in many other countries where even after raising interest rates for about a year, inflation still remains slightly above or way beyond their mandated levels, and they are still struggling to counter slowdown in growth using monetary policy. For example, a case in point is Eurozone, where growth has slowed down significantly. Possibly most countries are in recession, but the central bank is still raising interest rates, which is very, very counter-cyclical, very, very counterproductive. So it will continue to hit the economic growth. But in case of India, two very important points. First is monetary policy remains much more favorable. Second is that if you look at the real policy rate, which is the central column, right? India is probably the only country which offers a real policy rate, okay? Which means that if you inflation adjust our bond yields or our benchmark rates, you get a positive return with stable inflation and one of the highest growths in the world. So this is a combination which I don't think is available in many other countries. So for example, if you look at Thailand, where inflation is also under control, but policy rates are negative. Even for that matter, if you look at other countries, for example, in case of China, growth has slowed down significantly from where it used to be. Inflation, although is very, very low in China, lower than what even central bank wants. So they are struggling the other way. They are not able to revive at a very fast pace, right? For other countries, I think things are extremely difficult. For example, in case of Brazil, inflation is low, interest rates remain very high in order to protect the currency, and economic growth is still struggling, right? So most countries are either struggling on growth or struggling to control inflation or both. In case of India, I think we check all boxes. We are not hitting sixes out of the park. We are not doing something special, but I think we are growing at a steady pace, which is which is the exception in today's world and possibly better than most peer sets. So this offers very strong footing for India macro, and I think it will also play out for positively for India's growth. And why is that the case? So this next chart is very, very important. And we made a similar chart in December 22, where we said that India has the least constrictive monetary policy. And in that slide, what we showed is that our GSEC yields have peaked out at the lowest level uh, versus all the past cycles. So in the past cycles, our GSEC yield peaked out at 8.5, 9.5%. In this cycle, they peaked at 7.5%, 7.6% or so, right? Um, Second and more important point, when you look at the peak rates for corporate borrowers, the AA or AAA borrowers, in this cycle, they have enjoyed the lowest peak rates. That means the worst rates which were available in this cycle were lower by more than 100 basis points from the last cycle, right? Which is again a very, very important indicator. And if you read this yellow highlighted part, 100 bips lowering in borrowing cost across the economy can cause 80 bips higher growth rate. So for example, if you were to grow at 5%, if the peak borrowing cost or average borrowing cost in that 5 period is lowered by 100 basis points, economic growth will accelerate to 5.8%. So I think this is a matrix and phenomena which will play out over the next 5-7 years. And it is largely missing from the discourse right now and possibly quite positive for our economic growth. So this is something which I think is visible across three parameters. One, GSEC yields being lower. Secondly, corporates being able to borrow at lower rate. And what is the reason? One reason is that interbank liquidity continues to remain either neutral or in surplus, which has never been the case in India historically. So these are the conducive conditions which are possibly going to help growth get revived at a faster pace and more durably. The next is two slides from two different sectors. One is again a conducive conditions for capex. We think that there are significant reasons why the capex cycle could be a little longer in India, and this could be the start of the cycle, or possibly we have already started. And four reasons we have enumerated here. First is that the government expenditure is on the rise. You can see in FY14, the share of capital expenditure in the government budget was 12%. It has risen to 22% today, and one of the highest numbers. Even I think global, research outfits and number of publications have highlighted how spending on infrastructure in India has been rising at a very, very steady pace. Even our last and previous report showed data where it was very clearly visible that this number is quite healthy. Second and more important point, that if you look at the share or the proportion of order awarded, and you can see very clearly that private sector is making a comeback. Their proportion had fallen to 4-5%. It is back to 10%. That number used to be at 35-20% during the boom period when government was pushing capex to a very large extent. But on an average, I think this number is at 12-13%. If we reach that number, it's a very, very healthy number. And possibly we are headed in that direction. That means private capex is also happening. So if you split capex in India, for example, if you look at investments to GDP ratio and take 100% of it, nearly 48% comes from households, right? Another about 30-35% comes from the private sector, and about 15% comes from the government, which is state and center, right? But when you look at these numbers, and if you split them up in terms of order of audit, you will see that the very large share comes from center, state, and PSU, right? And these numbers have been steadily growing over time, and we think that the growth will continue, at least for the next 2 to 3 years. Third is why private capex is also a good possibility. So when does private capex happen? One, when there is a demand revival, which leads to higher capacity utilization level, which leads to more visibility, and therefore corporates go and do capex. So what we are saying is that possibly the demand conditions are favorable, not at very fast pace, but they are steady. Capacity utilization level across the economy has been rising steadily. Even RBI has given that data over the last 6 months to 1 year repeatedly. And third thing is that the corporates have very healthy balance sheets, right? So just to give you one case in point, BSE 500 net debt, which was 12 lakh crores prior to COVID, is now 8 lakh crores, right? And second and more important point, corporate profitability has improved significantly. So if you look at this chart, let me magnify this chart and tell you, which is very, very important. So if you look at BSE 500 PAT between FY13 and FY18, or let's say the COVID year where the COVID plunge happened, it was just close to 3.5 lakh crores, right? That was a steady number. It was rising, then it fell with COVID. But look at the pace of growth after COVID, how corporate profitability has gone up. So very large corporate profitability, cleaner balance sheets, and possibly a revival in demand, we think that are very, very conducive conditions for capex to come back. And this is also getting reflected in India getting a lot of manufacturing FDI. So we got a record manufacturing FDI in 2022, which we haven't received ever. And for the last 4-5 years, it was very, very flattish. There was a big year in FY17. But since then, we haven't had any large year. And this was the first year where 16 billion has come in. And we can see there are a lot of promises from a number of large companies to do capex in India, right? The next is the auto sector, where two very important data points which I want to tell you. The top left is the domestic PV market, and the top right is the how the mix has changed. So if you look at the passenger vehicle, if you divide them among cars and SUVs, you can see that SUV share has gone up significantly. Car share has declined. And why that has happened is that premiumization has taken place. Overall, the sector hasn't done much. So when you look at this number, look at this FY23 number, right? So we've been selling about 40 lakh cars, in FY23, slightly lower. And we were selling about 37, 36 lakh cars even in FY19. So even by FY22, we had not reached our 7-8 year highs. FY23 for the first year. And if you subtract the SUV growth, this number will be even lower. We haven't seen any significant growth, which means that X of SUV, which is largely a urban market product, autos haven't seen any significant growth, only premiumization. Similarly, if you look at the two-wheeler numbers, even in FY23, we haven't reached our 10-year highs. We have similar sales number as we had in FY14 and FY16. In FY24 also, we'll not breach those numbers. But the point is that we are probably coming closer to a revival. Even in case of two-wheelers, you will see that premiumization has taken place, where premium segment, which is the green part, has gained market share, right? So over the last 7 to 10 years, the story which has played out in the auto sector is more of a premiumization than of a secular uptrend, right? And we believe that because demand conditions are now reviving, and possibly semi-urban and rural India is also witnessing a comeback, there is a good case to be made that auto sector as a whole will see secular growth at least for the next 3 to 5 years, which again tells us that auto sector will throw out a lot of investment ideas, right? So these were the ideas from today's Netra. Just to summarize on what we have discussed is, initially we saw that US debt ceiling has become a very important event which is upcoming. Markets have not really paid attention to the event, but we know from past data that markets can become jittery very, very quickly. So be ready to listen to news headlines about US debt ceiling over the next 20 years. 20 days. If it gets resolved, well and good, it will have no impact. But over the next 20 days, if there is an impasse and there is a to and fro in the US Congress, it will create volatility in the market. And the best way to hedge, best way to navigate the event is to hedge volatility. Second, we saw that possibly demand side inflation will also cool off, including the supply side inflation. And that will eventually lead to an outperformance in gold, because gold performs brilliantly when US enters a rate cut cycle, which possibly could start in end of 23 or early 24. The last part where we saw India macro remain stable, it offers better stability because our monetary policy structure and outcome has been much better than peer set. We have had the least constrictive monetary policy. That means peak rates have been much lower, which adds to growth and adds to better stability. Two sectors we spoke about, that capex cycle could well be underway because all conducive conditions are present, and auto possibly could enter into a secular trend.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.